Ladies and gentlemen, good day and welcome to the Q4 FY24 conference call of Newgen Software Technologies Limited. As a reminder, all participants' line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Deepti Mehra Chowk. Thank you, and over to you, ma'am.
Thank you. Good afternoon, everyone. I am Deepti Mehra Chowk, Investor Relations, Newgen Software Technology Limited, and I would welcome you all to Q4 FY24 results of the company. Joining with me today on the call is our management, Mr. Diwakar Nigam, Chairman and Managing Director, Mr. Varadarajan, Founder and Whole-Time Director, Mr. Virendrajit, Chief Executive Officer, and Mr. Arun Gupta, Chief Financial Officer. Due to bad throat of Mr. Nigam, Mr. Varadarajan would take up presentation of the results. Before we move on to the discussion, let me highlight that this call may contain certain forward-looking statements concerning Newgen's future business prospects and profitability, which are subject to a number of risks and uncertainties, and the actual results could materially vary from the forward-looking statements. Past performance may not be indicative of future performance. The company does not undertake to make any announcement in case any of these forward-looking statements become materially incorrect in future, or update any forward-looking statements made from time to time by or on behalf of the company. For further details, you may please refer to the Investor Relations section of our website. I would now hand over to Mr. Varadarajan for presentation of results, which will be followed by Q&A. Thank you.
Good afternoon, everyone, and thank you for joining us for our Q4 FY24 financial results call. As we reflect on the past year, it has been another remarkable year with financial performance reflecting considerable strength and resilience. We witnessed revenues of rupees 1244 crores, leading to a growth of 28% YOY. The year saw many milestones and opportunities to get deeper engagement with our clients. We have also witnessed robust profitability and healthy cash flow generation. Customer relationship has been always key for us and have been instrumental in our growth across all geographies, particularly EMEA and India, where we have witnessed growth of 39% and 33% respectively for the year. In India and EMEA markets, we are automating end-to-end for our customers by tying up the front, middle, and back office processes for them. We have seen strong interest and increased acceptability of our solution, including trade, finance, and digital lending, customer onboarding, card origination, and supply chain finance solution. In the APAC region, we have booked our largest ever project of rupees 97 crores with a leading technology organization in Singapore. In the Americas region, we have been resetting our strategy for the market. As part of our current portfolio, we are happy to share that with deeper engagement with our client, we have seen a notable increase in the business size per customer. We saw an increase in the number of customers with billing of over 5 crores from 51 last year to 65 in the current year. The average revenue per customer has gone up by 29%. This underscores our conscious emphasis on catering to larger scale clients and those who significantly contribute to our business. We are pleased to see ongoing growth in commitments from our existing banking customers, as well as healthy new logo addition to our portfolio. We have added 51 new logos in the year, 11 of which have come in Q4. For the year, our annuity revenues were at rupees 750 crores, comprising of 60% of our revenues. Coming to our products, over the past year, we have continued to our commitment towards innovation, constantly refining and expanding the capability of our platform. This year was filled with excitement with new versions, launches of several of our platforms, and deeper work on our solution. We have launched the AI-enabled version of Newgen One platform called Marvin during the year. We have also launched newer versions of ECM and CCM platforms. We have released our next generation low-code trade finance solution, IDP Studio, IDP standing for Intelligent Document Processing, with advanced machine learning algorithms and Newgen AI Data Science Studio. In the new version, we have incorporated new inputs from our customers, industry leaders, analysts, and etc., enhancing our platform's features and functionalities. We have worked on different aspects, including use of artificial intelligence, cloud, and microservices, security, empowering system integrator partners, and migration. This enables our platform to build next generation use cases, new ways to design the application, enhance the user experience, and optimize resource usage. Our vertical solutions in digital lending and trade have done well, and we continue to build on that base. Further, we are penetrating into the insurance vertical and strengthening the theme for the same. During the year, we continue to be recognized by industry analysts, Gartner and in the Magic Quadrant, and Forrester in the Wave reports. We are also recognized for the first time by Everest Group. Despite the challenges, including the recent cyber securities, we have demonstrated resilience and came out very stronger. We are leveraging the collective strength of our global workforce, which has grown to 4,500 individuals and continues to expand and mature in alignment with our business growth trajectory. Central to our commitment to organizational success is our steadfast focus on talent management and learning initiative. We believe that by empowering our employees with the skills, knowledge, and tools they need to succeed, we can foster a culture of excellence and drive innovations and growth. We are constantly working on increasing our global footprint and brand presence. We opened our offices in New York and Saudi Arabia during the financial year. We also continue to work on enhancing customer engagement, strengthening our sales team and partnership network, and expanding our digital presence. On profits and margins, we delivered a healthy growth in profits and expanded margins during the year. Profit after tax was at 252 crores, witnessing a growth of 42% YOY. We continue to prudently invest in R&D and sales and marketing initiative. During the year, we have invested 9% of our revenues on R&D initiatives and around 22% of revenues on the various sales and marketing activities. On the balance sheet front, we witnessed a robust cash flow generation with our net cash generated from operating activities for the year at rupees 281 crores. Our net trade receivables were at rupees 444 crores as of 31st March 2024, which resulted in net DSO of 130 days. Our collections for the year have improved by 34% YOY. We have declared a dividend of rupees 4 per share post bonus issue of 1:1, which is rupees 8 on pre-bonus shares. Looking at Q4 results, we are happy to close Q4 with strongest revenue ever for a quarter at rupees 375 crores, increasing 23% YOY. Our PAT has also crossed rupees 100 crores for the first time in a quarter. As we start the new financial year, we remain steadfast in our commitment to delivering value, innovation, growth, and providing superior customer experience. Thank you very much. We are now open for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vaidik Sarkar from Unifi Capital. Please go ahead.
Virender, hi, good evening, and congrats to you and the team on a strong quarter and what's been a phenomenal year overall. Obviously, multiple things are firing for us today at the same time. But I think the best way to synthesize all of this is to ask you, if in your words, like you said this in the past few quarters, if your order book and your deal pipeline is perhaps growing at a pace that is faster than your revenue booking is, and B, given where our order pipeline today is, where do you think we are in this cycle? Right? We reckon we're in the middle of the cycle, or perhaps moving towards the end of the cycle in terms of how banks and financial institutions are thinking about their digital journeys and how that's relevant to us.
Thanks, Vaidik, and thank you for your question. So you're right. So basically, order book gives us in terms of kind of an insight in terms of how the business is shaping up, and we have expanded our order book to roughly around some 1,560 crores from a previous around 1,300 crores. So there's a growth, healthy growth out there. But order book is, as you rightly said, is just one of the dimensions. The other dimension is about the growth in our new deals, which is about mining and new sales. Out there, we have also a substantial healthy growth in that order book. On the order pipeline, clearly, as of now, we still see that there's a good traction in the coming year, both in India and financial services and what we are doing in Middle East. And in fact, we find the next year to be as a very strong APAC recovery year. US, I think we are working. There are a lot of moving parts out there. There's a part of moving which is about our strategy, where we are trying to reset, trying to move away from the smaller entities to getting larger entities and reshaping the market. And there's also about the whole market in terms of being slow, whether it's the European market and US market. So I think that's a moving part. We are still working very strong. At beginning of every year, we are very, very hopeful to really make substantial inroads in everything. But the outcome depends on various factors. But going into next year, I think the pipeline is quite healthy. On the traditional space, it is very similar what it has been last year on the US side. There is not too much of a great jump by which I can predict a much higher US revenue growth. But on the other three markets, which are traditional markets, we are finding the pipeline to be very healthy. We are building the US pipeline. I think we are making forays into both larger banks and insurance, but it's still early to call it out. And also there is an outline in terms of our other markets, which are we are seeding, like Australia and UK. They have started showing some seeds. We did close some deals last year. This year we expect to close few more deals. So overall, we still look at next year. There's no reason why we can't maintain our growth momentum and do better.
Sure. So obviously multiple moving parts, and I will not get into details here, but I think you had highlighted an endeavor of about $500 million by the end of FY27, right? So, if we have to slice that into the products and the initiatives that will help us get there, how should we imagine each of these calls better?
Yes, you see, I think every company has a long what you call aspiration of doing large numbers, and as a product company, we always believe there's going to be a time thing we can even accelerate the growth rates even beyond what we have. Our growth momentums for all, whether it's a 500 million plan or typically next year plan, is still based on the core verticals we are driving. So one of the only thing what we are doing is we are opening up insurance in a major way. That's where a lot of investments are happening. So you should see that in next 3 quarters, 4 quarters, you would see a kind of a funnel, healthy funnel, and the deal closure happening in insurance beyond the banking, which has been our traditional strong space. Government is going to be, there's an organic growth in government. But on the market dynamics, we clearly still, for a 500 million picture to realize in the time span we are talking about, our mature markets have to fire, which is still a kind of a work in progress for us. And though a lot of investment is happening in those areas, I think there's a healthy push coming from the markets where we are strong, and especially in this era where hardly any IT companies have really struggled from the growth front. We have been doing substantially well because our customer bases have been in the markets which have been less affected, and our solutions have resonated in this time period as well in all these markets. So I think we are sitting well on that. but the business composition does not change much, but it changes slightly more focus on insurance to open it as another substantial vertical, and it focuses on mature market expansion more quickly. I hope that answers your question.
Yeah, and just the last one before I get back to the queue. Look, the pace of growth has been so momentous that reinvestment means that our operating leverage expectations have probably been faster than what we expected, right? So just keeping that growth in mind, how should we read your margin profile in the year ahead?
See, I think, as you know, most of the cost planning happens at the beginning of the year, and there's little variabilization which happens beyond some tactical manpower or SG&A expenses. Right. So I think, we have been given that, we don't aspire to generate very large margins beyond this healthy 20% net margin or 21, but it's going to be a function of that year. So in terms of if at the beginning of the year we are targeting, say, X% growth, but we end up doing slightly more than X, then the margin expansion would happen. So today we are targeting growth ranges which are similar to our past years, and so I think we should be able to maintain the margin. The other thing on the net margin side, I think maybe Arun will also comment, or you can get more data. I think the tax rates for us next year are going to be different. I think because on the SEZ side, I think this is the lowest tax slab will be this year. Next year will be on at least 2-3% higher tax or more than the current year. So there's on the net margin, while on the gross margin or the EBITDA side, you will still see expansion happening. On the net margin, we'll be able to maintain that kind of a margin.
So and just in terms of seasonal variability, Q1 has always been a step down. I mean, obviously that correlation was broken last year, Q1 of FY24. Given how things have shaped up for us last 2 quarters, and we're already a month into Q1 25. I mean, will we revert to the previous the relationship of a step down, or how should we read that?
We hope to keep on reducing seasonality. It doesn't go away. I think I don't expect Q1 to be bigger than Q4 even this year, but I do expect the Q1 growth rate to be slightly higher than our average growth rates. The way you have seen this year, I think we have had a higher growth rates on Q1, Q2, and then slightly lesser. I should not call them lower numbers. They're still very large numbers, but not at the same level. On an average, we expect next year also to have the same behavior.
All right. Thanks, Virendra. I'll be in touch. Thank you very much.
Thank you.
Thank you. The next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, hi. Thanks for giving the opportunity, and congratulations on good set of numbers. Sir, I wanted to understand the growth in the order booking. I mean, at this time in the presentation, we mentioned that the growth in the order booking is 20%. Versus this number was 30% last year, same time when we started the year. So should one see normalizing of growth happening, because this year has been quite a stellar growth. So should one see coming back us coming back to 22% kind of a growth? Because given the fact that now we are starting the order book with 20% growth, and last time it was 30% growth. So some understanding around that will be helpful.
Yeah, so Mihir, thank you for your question about order book is right. I think the order book growth on the previous base of last year was a much more muted year for us. It was a very small year for us, and on that we had a substantially large order book rate. So basically it jumped from I think 17% to 24%, 25% to 27%. So the order book of last year also has got some residual revenue which is going to come in this year as well. And with the growth of order book of last year, what we have built up from, we've taken the order book again from a very high base of 1,300 crores to 1,560 crores. We don't see order book as a constraint to reach, not meet our next year's goals. We don't intend to fall back to 20% growth targets. We want to maintain them at higher level. But what higher, I think that is how the future will unfold. But I don't think, while I see order book as one of the dimensions, but it can't be taken in isolation. So we still feel that this year can be a much larger number than the 20% number.
Sure, sir. And how should one understand the new dimension? And you mentioned order book is not the only thing to look at for the growth rate. So, I mean, which are the other dimensions that you are mentioning? If you can provide some clarity around that, that would be helpful.
I think it's the same thing. See, order book is one, I think new logo acquisition and average deal size per logo. So we have 29% growth on the deal size. That's where we are able to convert maximum. Our new logo additions are at a substantial pace, and all the new logos are at a much bigger size than the previous new logos. So these are some of the factors.
Sure, understood. So second question was on the insurance. I mean, you mentioned that insurance you expect this year to be remaining quite strong. Can you provide some more color around this? I mean, what kind of conversations are you having with the clients? Is it life and insurance or is it PNG? And what kind of quantum can we see on the deal size or on the revenue side for insurance? That will be helpful.
See, we are working on this strategy. So we have I think while we have expanded to a large kind of a wallet share in banking for our major accounts, we have not been able to do the same sizes, though we have insurance as our customers, but their deal sizes are pretty small. So we're working both in life, general and health. There are offerings which we are generating where we can have a larger deal size. This is work in progress, and we expect this to be a substantial part of our revenue in next coming 2 to 3 years. So it's early. So I think once we have a better visibility into the funnel generation part of it and deal sizes, I think we should be able to highlight more. But we are quite excited about it, and we are aggressively investing right now, building teams, building capabilities, competences, products around that, and then taking them to market in next 6 months' time.
Sure. So what is the growth in order booking for insurance? I mean, at the company level, it is 20%. For insurance, what could be the ballpark number?
I don't have that, but I think insurance we are just building right now. So I don't think insurance growth rates right now. I think even for this year, the last year, the banking has been the primary driver of the growth with more than 30% of the growth happening. So all other segments have been either at 30 or less than that.
Sure. Yeah, that's it from my side. I will join the queue. Thank you.
Thanks, Ray.
Thank you. A reminder to all the participants, you can press star and 1 to ask a question. I repeat, you can press star and 1 to ask a question. Next question is from the line of Ashish from JM Mutual Fund. Please go ahead.
Yeah, thanks for the opportunity. So any comments on the M&A strategy, and where are we in the GIS-led strategy? If you could throw some color.
Thanks, Ashish. So as I said, for a merger, I think we are looking at tactical acquisitions for speed to market and access to market, predominantly in mature markets. We have not identified any targets yet. I think but the work is going on, and we do expect that in next 1 or 2 years we should be able to make some amount of acquisitions for typically for making sure the mature markets we are able to gather some speed. But right now we don't have any update on that about from its work in progress on that side. Sorry, what was your second question?
So the GIS-led strategy. So how's that shaping up?
On the GSI-led, I think while we are working on enablement side, and I think our tie-ups in terms of both product to product types are happening, and that is growing. On the funnel side, we are still, because the funnel we are targeting still in mature markets. I think both for mature markets, the business for the GSIs, as you've seen, has not been that strong. And I think that also has resulted that we also have not any large growth in the funnels. We have some interesting cases, but I think I would still say it's not picked up to the speed or expectations which we wanted it to have fire at.
And in the past, we were also thinking of exploiting the system integrators to get into the US markets. Any development? Are we in discussion with some of the SIs?
No. I think we have a lot of alliances, partnerships. I think we have, in fact, we have expanded beyond the system integrators to the consulting companies, the top tier consulting companies, to form alliances on that. So that work is going on. I think I will not be in the position right now to comment on the size of business or the size of funnel because of that. I think it is early, and the GSI tractions have not shown the speed. I think their deal gestation sizes are very, very, very long, and I think we are still working on deal sizes which start from $500K to few $1 million. They have very different appetite, and I think if we become a part of that larger deal, we don't have the closure cycles are not under our control. So we are looking at various different ways to reset that whole strategy, as well as working with consulting companies in early stages of funnel building. So let's wait for few more quarters to see how it shapes up.
And just lastly on, so you're confident of organic revenue growth to be 20% and more. So where is US in this entire context? Would you say that US will continue to grow at a much lower rate than the console business?
No, not really. I think even the weakest of the US years still are around growth of 17% or 20 or 22. Last year was much higher than that. So I'm saying is that while on the organic side, if US does not give us great acceleration, we still can maintain high growth rates out in US. But what we expect to grow to a size of which is typically a 500 million or $1 billion company, the mature market has to fire. So at one moment, our business plans have to see that the US executes at a much faster rate. That is the moment we are waiting for. So in the meantime, all our markets have great potential to grow organically. And what organically is, we expect a minimum to grow at 20% or more organically. So and all markets can follow that.
And anything on pricing environment? So last question, sorry. Anything on pricing environment?
Yeah, so pricing is a continuous. I think one is, you see globally the prices have changed for everything, and I think both in IT products and as well as even the large players or small players. The cost itself for manpower and other services also gone up. So we are gradually looking at and evaluating various components of our products, services, and working with customers to keep on revising the rates right now. We will be working on some more serious initiatives over the next few quarters on pricing and resetting some of the pricing. But it's a continuous job. I think I may be able to give you more clarity than on next 2 quarters.
Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Ashish Chopra from Goldman Sachs Asset Management. Please go ahead.
Yeah, thanks for the opportunity. I hope I'm audible.
Hey Ashish, how are you? I can hear you.
Hi, yeah, great, thanks. So I think last year we saw the YOY growth start from 34% and then end at 23% in the fourth quarter. You highlighted that the trajectory this year also probably should be the same in terms of the way we should expect it. I was just wondering as to why should that be the case? And why, what was it last year as well that drove this phenomenon?
Yeah, so Ashish, I think it's simple function that our business is quite seasonal. Q1, Q2 on the total revenue side are much smaller quarters than Q3 and Q4. So as the growth is driven from new deals and what we have seen, the new deal acquisition is quite linear these days now. So we are able to still get higher mining as well as sales in all quarters laterally. Since the base numbers of those quarters are slower, the growth percentages are much higher. So you understand? So business in control, which is very linear in terms of renewals, they're very linear. So they get divided over 24, equal 12 months. But your deal velocity is not as lopsided as it was previously. So we are able to do closures in Q1, we are able to do closures in Q2. So the quarterly growth rates, because they are at a lower base, they end up having higher revenues. Does that explain?
So just to reconfirm if I understand correctly, so while the linear business obviously is sort of steady state, you're saying that the closures of deals now happen in a more spread out fashion versus probably the previous years.
Exactly.
Yes. Okay. Understood. Got that. Got it. Yeah. And secondly, I mean, you mentioned about a couple of vertical solutions that are doing well for you, like digital lending, trade finance. We just wanted to understand as to, what would be the nature of solution in the insurance vertical as well, which you're looking at in terms of the problem point that would be the problem statement that you would be looking to solve. And also, I mean, the vertical solutions today, what percentage of your revenues could be coming from such very specific industry solutions?
So Ashish, I think you're right. On the vertical side, our recent platforms, which are actually also built on the same horizon, these are built on low code. So we are trying to reinvent products on traditional banking, whether it's a digital lending platform or a trade finance or a supply chain, on the low code approach to do them as a next generation product. So on the insurance side, we are exactly targeting very similar. We are talking of journey-led solutions where we are right now automating the whole process, whether it's a claim or onboarding, both in life and general and health. And what has happened, why these solutions are being reinvented, we thought that there is a lot of digital ecosystems and stacks which have got evolved in all countries. And people want to have a very differentiated journey of in terms of how they are able to onboard their customers or issue policies or do the claims for that. So very similar to what we have done in banking, but on the insurance side. On the point of how much of business is driven predominantly, so what is happening, a large part of our business today is also driven from solution stack beyond horizontal. I don't have the exact number, but Dipti can provide those numbers in terms of for each accelerators, what is the kind of business. But at the end, for every sale, whether it's a horizontal or a vertical sale, the large part of that sale is a horizontal product sale for us. Because customers end up buying these accelerators with the hope that they can build more products over that. So at the end, we are always a horizontal play in an account with an entry strategy or a solution-led sales focus around a vertical accelerator.
Understood.
Does that answer your question?
Yes, it does. And you mentioned that you expect APAC next year for APAC to be a very strong recovery year. Is that on the back of the largest deal that you signed in that region, or are there some more elements also that are contributing to the thing?
No, see, if you look at last few years, APAC has been always a strong growing market for us. I think last year has been an anomaly in terms of a lot of misses on deals in terms of closure, contract cycles, and also market being not responding to us or in terms of closure rates as we expected. I think even just recovering back to a normal stage should give us a healthy growth. I'm just relying right now on that. The deal which is there of around 90 crores, it is a 5-year deal of subscription and an implementation. There will be some revenue, but it will not going to make a material difference to the growth rate. So we still feel in terms of our velocity of deal closures and growth in that market to be on the recovery rather than the last year approach.
Understood. And just lastly from my side, on the DSO, as we exited the year at around 130 days, so on a fourth quarter basis, is that the kind of number, consistent kind of growth you tend to witness in the last quarter? Would that be on the expected lines, or do you think that it may have come in higher than what you would have been targeting?
No, I think DSO is on the expected lines because I think we had a kind of a DSO miss on Q1 because it was slightly higher last year. And then we substantially brought it down. I'm saying comparing to Y-on-Y quarters, it has come down. On an average, because Q4 is always a large quarter, so the DSO number is much larger, but on the average other quarters. So I think we should be on an average DSO of 120, 125, I don't know exactly the number. Our target is to reach 100 days. That's our immediate target as an average DSO. That would mean a Q4 DSO of 115 days or something like that. So, but this year I think it's in line with our expectations, but we are taking a lot of measures to even bring it further down.
Understood. Great. Thanks so much for taking my question and all the best.
Thanks.
Thank you. A reminder to all the participants, you can press star and 1 to ask a question. The next question is from the line of Jyoti Singh from Arihant Capital Market Limited. Please go ahead.
I'm audible.
Yeah. Could you be a bit loud, so?
Yeah. So thank you for the opportunity. So if you can just give an idea on the BPO segment that very small for Newgen. 2%. But what are the impact that we are seeing because of the Gen AI, and what are expectations from here onward?
Jyoti, thank you for your question. So, BPO segment is a segment because it has been a traditional segment where typically people are doing, we were a great partner for most of the BPOs got set in India in terms of when they're looking at a fresh stack because they didn't have platforms. Suppose that segment has been typically the AP/AR segment, account payable and account receivable, either it's in the captive or non-captive, which are the BPO based segments. So it's a potential market for us for horizontal play. Has not shown significant traction in India for us or outside India. So we're looking at ways to look at more horizontal play. Coming to GenAI in BPO, I think it's typically wherever you can bring efficiency in operations using technology. I think the processing centers become the first, typically the places to try out, like if you had RPA or the BPM. Similarly, I think both on generative AI, a lot of use cases in terms of automating some of the routine tasks would happen out there. We are excited about the platform play in our product. We have created our product offering in all three products, which are our horizontal lines. There is a GenAI offering, both for whether it's content, going deeper into content summarization in content management, BPM automatic rule building or accelerating the speed by which the processes can be deployed, and CCM also, which is customer communication, how fast you can do a multilingual communications depending on different personas. So we are excited about that portfolio. We are right now looking at those cases to be taken across all verticals, not limiting to BPO. So yes, but BPOs do have some use cases which can be exploited on that. But right now, I won't have more than that insight about that subject.
Okay, thank you. And sir, next question is on the Gen AI side. So since when we are starting, it will be revenue generation for us.
So basically Gen AI is a technology, and as any horizontal grade technology, product companies end up leveraging that and creating more offerings. Finally, those offerings are deployed with the customers to either optimize their businesses or drive growth. So what we are excited that with Marvin, which is our Gen AI launch, and the number theory, which is the AI platform, we should be able to accelerate our use cases and growth of those use cases in general. But specifically on revenue generation or not on revenue generation, those will depend on how end customers end up deploying the use cases.
Okay, thank you, sir.
Thank you. The next question is from the line of Tushar Sarda from Athena Investment. Please go ahead.
Yeah, thank you. I have two questions. One is, you said mature markets have to fire much higher. So what kind of growth rate, would you look at to reach your aspirational targets? That's one. And second, because markets are not doing well, M&A should be much easier in this kind of market. So your thoughts on that?
So Tushar, thank you for your question. So when I say mature markets have to fire well, it's typically for our long-term aspiration of a company to be reach $500 million or $1 billion. So because that is where the addressable market is. Today, I think at a growth rate of about 20%, mature markets keep up that pace. Then eventually we will not be able to do justice to the addressable market size in mature markets. So we expect to be much higher. For some years, it can be a 30, 40, 50% growth in mature markets. That's quite doable for a company like us. So, it's more about where the addressable market is and where our share of, how do we increase our share of that addressable market. On M&A strategy, I think, as I told you, our M&A strategy is typically localized around to get access to market so that we can do speed of our full sales process establishing in a country. We have not found too many prospective options right now. Depending different market conditions should generate sometimes opportunities and sometimes challenges. I am not really in a position to really comment on that because I have not really felt about that there is too much of availability right now. We have not sensed that.
Okay. Thank you very much.
Thank you.
Thank you. A reminder to all the participants, you can press star and 1 to ask a question. Next question is from the line of Shubham, an individual investor. Please go ahead.
Congratulations on a great set of numbers, sir.
Thanks, Shubham.
Would you be providing any kind of guidance for the next financial year, sir?
No, Shubham, sorry, we don't provide any guidance, but we, as we always say, we intend to keep on meeting our growth momentum and do the historical rates which we end up doing. We don't see challenge. In case there's a kind of a delta which is very different than what we did last year, or both upside and downside, then we would inform you as soon as we have more insight into that.
All right, sir. Thank you so much.
Thank you. The next question is from the line of Devang Bhatt from IDBI Capital. Please go ahead.
Hi, sir. Thank you for taking my question. Just one question that you had highlighted that you are resetting your sales strategy in the US. So from the past, what different are you doing? Like you have already tapped GSIs and all to tap the mature market. So what kind of resetting in sales strategy you are doing in US?
So Devang, when we are talking of resetting our sales strategy, which is about what was working for last 3-4 years, we were pursuing banks which were typically in the lower size or typically asset bases of $2 billion to $20 billion banks, which is a large number of roughly around 850. We saw that, I think the account acquisition cost was much more higher than the lifetime cost of the customer. And because the US banking also is kind of in terms of either consolidation phase or they are having a lot of issues raising deposits, these accounts, even after acquisition, did not have a lot of upside for us. And for our aspiration and the numbers we are talking in those companies, we thought that it is important to pivot towards larger banks. So when we are talking of change in strategy, we are talking of pivoting from the smaller bank sizes to a larger addressable bank, which are banks above 20 billion or 50 billion up to $200 billion, which is typically around 100 accounts. So we are focusing on those accounts now. And of course, there is an entry barrier to those accounts. It needs GSI support. It also needs various other things. But I think the lifetime value of those accounts will be much more meaningful for our company. That is the change we are talking about.
Yes, sir, we have been trying this. I mean, previously also we were doing this of targeting the larger banks. So in terms of, now for targeting larger banks, have you come out with some other sales strategy that, that was not working in the past and now it will work?
Yeah, absolutely. I think, first of all, even in the larger segment, we have at least been able to get 3 or 4 accounts. It's not that we have not got inroads in that. The second strategy is about to keep on accelerating that. And I think we have built up a different sales team. We are looking at product definitions which are more suited for that. We are looking at working with consulting and SI companies to target those. Yeah, but as having said that, you're absolutely right. That has not reflected in the numbers of growth right now. So that's why I call it work in progress. But I'm very hopeful that we should be able to crack it. It may take a few more quarters, but we should be able to make that.
Great, sir. And last one thing, would you be targeting any M&A in this mature market which will help you in, garnering these larger banks?
Yes, I think we have a plan to look at some inorganic expansion for the segments which we want to address and tackle so that we get more inroads or kind of more feet on the ground out there rather than building that organically. And that is one of our pursuits. Right now, we don't have any final contenders or anything localized, but we are in the process of doing that.
Great. Thank you, sir. Thank you for taking my question.
Thanks, sir.
Thank you. A reminder to all the participants, you can press star and 1 to ask a question. The next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, hi. Thanks for giving the follow-up. Sir, you mentioned that banks above 50 billion are somewhere your larger accounts are. Can you provide me how many banks are there which are more than 50 billion as of now? I mean, how many clients are we having?
So we are targeting the banking base of roughly around 90 banks which fit in that. They are not mega banks and they are not the smaller banks. They are above 50. So these 90 banks should be able to good enough market. And our target is to make sure that in next 3 years we have at least more than 25 to 30 such accounts.
Okay, sure. And as of now, are there any accounts over there in that range?
I think we have 3 accounts in that range.
Okay. And these 3 have been added last year or how was it?
No. I think last year in that range we have been only able to acquire 1. That's right. One or yeah.
Sure. Sir, I just wanted to understand this fundamentally. I mean, as we move the value chain up to larger banks, do we need to fill more product gaps or anything around it, or is the same product offering even applicable for larger banks? I mean, how would you see that?
In fact, one of the reasons why we are seeing our product offering was more applicable to larger banks. rather than, because the platform-led play where people want to buy platform for future users beyond the current solution. Because the smaller banks want to fill a need with the most price-effective solution, while larger banks are looking at technology and platform for long-term use. So we are inclined that the current offering set we have, of course, we'll be looking at complementing that, working on integration ecosystems, building more complementary, features for that market. That's a job we do well. The issue is we think the relevance of what we do is more to larger accounts than smaller accounts. That's why we made this pivot.
Okay, sure. So basically what I understand that the gap which is there in GTM strategy and not product per se.
No, yeah, you're absolutely. We don't. So there will be incremental things to be done in the product, but right now the gap is predominantly on the GTM side.
Sure, sure. My second question was on the trade finance revenue. What's the trade finance revenue in FY24?
I think we would have crossed 100 crores or something. I'm not sure, but I think we can send you that data. But we did get around six deals in trade finance, and I think all deals are above 10 crores, or some of them are much larger than that. So.
Okay, so basically 6 to 7 deals with roughly 100 crores of revenue.
Probably, but I think you can ask Dipti for more.
Just a rough cut number. And what was this number in FY23?
We started maybe 2 deals or something, 2 or 3 deals in that.
Okay.
Yeah, maybe 40 to 100 crore, that kind of a jump.
Sure, sure. And what kind of traction, what kind of inquiries are you seeing incrementally for FY25 on the trade finance side?
Yes, so I think since the product segment is quite hot, so there is an inquiry, but I think we are going because I think it's unlike our traditional products which don't have large implementation cycles. Trade seems to have a much larger implementation cycles. We are really narrowing down early our set of targeted accounts, slightly going only after larger deals, and trying to make sure that we have the right fit for all the markets. So we are now focusing on Middle East and India. We are not expanding drastically. So we are evaluating whether we should do it in APAC or in Europe or in US. Those things were on hold yet. So, but India and Middle East itself has a large potential. So for next year, I think that is where our focus would be, and then we can look at also beyond that.
Sure, yeah, that's it from my side. Thank you very much.
Thank you, Mayor.
Thank you. The next question is from the line of Vinay Nadkarni from Hathway Investment. Please go ahead.
Yeah, hi. Just wanted one question. How has the Marvin been accepted by the AI, and what is the channel response to it? And what is the revenue that you have earned out of it this year?
Yeah, Vinay, thank you for the question. So, see, Marvin is an extension of generative AI capability for our own products. And it does not have a different alternate monetization stream, but it eventually creates more use cases where the product can be serviced right now. So we launched it some time back, not maybe few months back. I think right now, as the whole industry is damn interested in anything which is AI-led or generative AI-led. So there's a lot of interest in those use cases. We are seeing a lot of interest in horizontal mature market use cases around AI, and sometimes also use cases lead to generative AI. But I will not be able to, we don't think of monetizing it separately. We think of opening more opportunities, but at the end we are still selling our BPM, ECM and CCM platforms or solutions built around that, with Marvin capabilities to enhance the value to the customer.
Okay. One small bookkeeping question. Your 9% expenditure on R&D has been expensed out in the books, correct? That's the way you have been doing all
Yeah, we always do that, yes.
Yeah. And lastly, just more forward-looking thing, since between banking and insurance, you're almost 77% of your revenue comes from these two industries. I understand you're focusing on that as a primary driver, but going forward, is there any other areas that you're looking at? Because your healthcare and BPO has not really taken off much. So are we going to be hitching our star only on banking and finance going forward?
So you're right, banking and finance will continue to be the global leaders for us across all verticals. Healthcare is typically healthcare insurance, which is very similar to healthcare, but it's a completely different segment, and this market only exists in US. So we think we can build anywhere between $15 to $30 million business of that over the next 2-3 years. But beyond that, I think government is one important area where we think we can build more inroads. After that, our horizontal products have quite wide application across, but that is what we are looking at either through partner sales or a channel sales or through GSIs to take us to other verticals. So we do believe that our horizontal sales, which is across beyond the banking and financial service vertical, should also pick up, but we are looking at as a different channel sales rather than a direct sales model in that.
Okay. Thanks a lot. Thank you very much.
Thank you very much. Thank you.
Thank you. As there are no further questions, I will now like to hand the conference over to Ms. Deepti Mehra Chowk for closing comments. Over to you, ma'am.
Thank you so much, everyone, for joining in for the call. For any further questions, you can connect with me or you can go to our website. Thank you.
On behalf of Newgen Software Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.